Why the U.S. won't pay down its debt? It's true that the U.S. national debt has grown to over $33 trillion, but there's still no real plan to pay it off. Why is that the case, and what does it mean for our economy? For many years, there has been disagreement over the size of the U.S. national debt. The United States has about $33 trillion in debt as of 2024, and the amount is still rising. Even still, the nation has little intention of making good on this staggering amount anytime soon. For what reason is that the case? Is there any strategy in place to deal with this enormous debt load, or are we just going to have to accept debt as a necessary component of the American economy? Recognizing the character of the national debt, it's crucial to first understand what the national debt genuinely entails. In essence, the national debt is the result of previous budget deficits, in which the government spends more money than it takes in from taxes. The government issues bonds, basically IOUs, to investors who can include foreign governments, businesses, and private citizens when it needs to borrow money. The government pledges to reimburse bondholders for their money plus interest. Many people believe that eliminating personal debt and paying down the national debt are equivalent processes. However, there are notable distinctions. First off, unlike people or companies, the U.S. government is not in danger of going bankrupt and is able to print its own money. Furthermore, the national debt is frequently viewed as a tool for boosting the economy through investments in social programs, infrastructure, defense, and other areas rather than as a personal responsibility. In fact, having debt is normal, even expected, for a prosperous country like the United States. Governments borrow money to make investments in their futures, such as constructing new highways, increasing access to healthcare, or preserving a potent military presence around the world. Whether or not the United States should pay down its debt in light of the current circumstances is more important than whether it can. Political dynamics, an unending battle. The main cause of the United States' inability to repay its debt is political impasse. All political parties must work together to lower the national debt, but in Washington, D.C., this kind of cooperation is uncommon. Reducing the debt would necessitate either increasing taxes, decreasing spending, or a combination of the two actions that are highly unpopular politically and frequently jeopardize the careers of legislators. The opinions of the major political parties in the U.S. on debt management are radically different. Democrats usually argue for a balanced strategy that includes tax increases on the wealthy and wise investments in infrastructure and education, while Republicans frequently support for lower government expenditure, especially on social programs. But since war spending, entitlement spending, and interest payments on the existing debt keep rising, neither party has shown that they are committed to reducing the debt in real terms. Politicians are motivated to prioritize short-term profits above long-term fiscal sustainability, which further complicates matters. Reducing the national debt would necessitate tax increases that voters might not approve of, or painful changes to well-liked programs like Social Security or Medicare. In light of the fact that voters and political funders want instant results, many lawmakers believe that the political costs of supporting debt reduction outweigh any potential economic advantages. The economic priorities role. Economics is another important factor in the United States' inability to pay off its debt. Rather than lowering its debt load, the government frequently prioritizes stabilizing the economy and promoting growth. When there is economic uncertainty, like during a recession or financial crisis, governments usually borrow money to finance deficit spending. One popular economic theory, Keynesian economics, contends that governments should raise expenditure during recessions in order to stimulate demand and aid in the recovery of the economy. For this reason, the U.S. government racked up enormous debts in an attempt to boost the economy following the 2008 financial crisis and once more during the COVID-19 outbreak. This spend now, worry about the debt later mentality is frequently viewed as a necessary evil in order to prevent more dire economic outcomes, such as widespread joblessness or company collapses. Interest rates are also quite important. Interest rates have been historically low for years, which allows the U.S. government to borrow money at a reasonable cost. With interest rates so low, there is little reason for the government to pay down debt when it can borrow money at little cost and use it to fund economic expansion. The federal budget can be greatly impacted by the government's ability to borrow huge amounts of money during low interest rate times. In these circumstances, debt repayment seems needless, especially considering the nation's more pressing requirements, which include infrastructure, defense, healthcare, and education. Global financial system, reserve currency of the world. The United States' distinct place in the international financial system is another important factor contributing to the country's lack of debt pressure. The dollar is the default currency for the majority of international transactions and is held in significant numbers by governments and organizations worldwide, making it the reserve currency of the world. The United States now has a great deal of financial flexibility. Treasury bonds are bought by nations like China and Japan, two of the biggest holders of U.S. debt. since they are seen as reliable and secure assets. The United States may continue to borrow with a low risk of default as long as the dollar is used as the standard currency for international trade. Because U.S. bonds are thought to be among the safest investments in the world, demand for them is robust even while the debt continues to rise. This is especially true when investors look for safe havens like U.S. Treasury bonds to secure their money amid uncertain global economic times. Interest payments issued. Even if the United States might not be under imminent pressure to pay off its debt, the expense of servicing that debt, that is, paying interest on it, remains a major problem. Interest payments increase in tandem with debt growth. The United States paid more than $475 billion on interest alone in 2023. These payments just keep the government current on its obligations. They do not lower the principal amount of the debt. The cost of debt payment might skyrocket in the event of an increase in interest rates, severely straining the federal budget. A fiscal crisis could result from higher interest payments crowding out other expenditure priorities like defense, infrastructure, or education. As long as the economy grows faster than the debt, some economists contend that the United States can continue to manage its debt. That being said, there is no guarantee. In the event that interest rates rise and economic development slows, the United States may find itself in a tight financial spot. Balanced budget myth. A large number of Americans think that the government ought to manage its finances like a home. This comparison is not accurate, though. Governments, as opposed to people, have significantly greater control over their income through taxation, the ability to print their own money, and the ability to borrow at far cheaper rates. Although theoretically logical, balancing the budget could have detrimental effects on the economy. Aggressive budget cuts have the potential to worsen vulnerable populations, diminish government services, and start a recession. A large tax increase may hinder economic expansion and lower consumer spending, both of which would be detrimental to the economy. It is not required of governments to have balanced budgets annually. Is debt a problem at all? It's critical to recognize that there are risks even with all the justifications for why the United States will not pay down its debt. The United States may be able to maintain its high debt levels for the time being, but this is not a given. Future financial crises could be brought on by rising interest rates, weaker economic development, or a decline in trust in U.S. assets. High debt levels also make it more difficult for the government to respond to future crises. In the event of a future recession, pandemic, or war, the United States may find itself with less financial flexibility if it keeps running enormous deficits. Additionally, if the government prints too much money to pay its debts, high levels of debt may cause inflation. Even while recent decades have seen relatively low inflation, the COVID-19 pandemic-related spike in prices serves as a reminder that this risk does exist. Ultimately, because it doesn't need to right now, the United States will not pay off its debt. It is simpler to carry debt than to lower it due to a number of factors, including political impasse, economic objectives, and the nation's standing in the international financial system. That does not, however, imply that the debt should be disregarded. The United States government may eventually have to face its mounting debt as interest payments increase and economic circumstances shift. However, paying off debt isn't a top priority at the moment because debt is still an instrument for preserving economic stability. The true difficulty lies in managing debt in a way that promotes both immediate economic growth and long-term financial sustainability, rather than in totally getting rid of it. It remains to be seen if the United States can achieve that equilibrium. Don't miss out on more insights like this. Hit that subscribe button and turn on notifications so you're always ahead of the game when it comes to mastering your financial future.